Tax-Free Millions, written and published by Rich Audiobooks. Lesson 1. Real Estate Depreciation Loopholes. Real estate has long been considered one of the most powerful wealth-building tools, not just for its appreciation potential, but for its remarkable tax advantages. At the heart of these benefits lies depreciation, a concept that allows property owners to deduct the theoretical wearing out of their buildings from their taxable income, even as the property likely increases in actual market value. The real magic happens when investors combine depreciation with leverage. When you purchase a $1 million 0-cents property with 20% down, you're receiving depreciation deductions on the full property value while only having invested $200,000, 0 cents. This means your cash-on-cash return from tax savings alone can be significant, even before considering any actual cash flow from the property. Sophisticated investors often layer multiple properties with staggered purchase dates to create a continuous stream of depreciation deductions. As older properties' depreciation schedules begin to wind down, new acquisitions provide fresh depreciation benefits. This rolling approach helps maintain consistent tax savings year after year. The passive activity rules present a potential limitation for some investors, as rental real estate is generally considered a passive activity with losses that can only offset passive income. However, real estate professionals who spend the majority of their time in real estate activities can deduct these losses against any type of income, including high-earning W-2 salaries. This creates an opportunity for one spouse to qualify as a real estate professional, while the other maintains a high-paying career, allowing the couple to offset their combined income with real estate losses. Bonus depreciation and Section 179 expensing provide additional opportunities for accelerated write-offs. Recent tax law changes have made these provisions even more generous, allowing for immediate expensing of certain property improvements and equipment. Strategic investors can time these improvements to maximize their tax impact in years with particularly high income. The true art of real estate tax strategy lies in combining depreciation with other real estate tax benefits. Interest deductions, property tax write-offs, travel expenses, and home office deductions can all be stacked alongside depreciation to create a comprehensive tax shelter. Some investors even use their children's involvement in the business to shift income to lower tax brackets through legitimate property management roles. When properties are eventually sold, investors can defer gains through 1031 exchanges, effectively resetting depreciation schedules with new properties while postponing tax liability indefinitely. Those who hold properties until death provide their heirs with a stepped-up basis, essentially erasing any depreciation recapture tax liability that would have been due on sale. The strategic use of real estate depreciation represents one of the most powerful and time-tested methods of legal tax reduction available to investors. While the rules are complex and proper structuring is essential, the potential tax savings make it worth mastering these concepts or partnering with knowledgeable advisors who can help implement these strategies effectively. Lesson 2. Offshore Corporations. The world of offshore corporations represents one of the most sophisticated yet widely misunderstood tax planning strategies available to wealthy people and business owners. While Hollywood might portray offshore structures as tools for illegal tax evasion, legitimate offshore corporations serve as powerful vehicles for legal tax optimization when properly structured and maintained. At its core, an offshore corporation is simply a business entity established in a jurisdiction outside your home country. The United States taxes its citizens on worldwide income, but through careful offshore corporate structuring, you can legally defer U.S. taxes on foreign earned income until it's repatriated. This timing advantage allows wealth to compound tax-free in foreign jurisdictions, often for years or even decades. The key to successful offshore corporate planning lies in understanding Controlled Foreign Corporation, CCFC rules. These regulations were designed to prevent U.S. taxpayers from indefinitely deferring taxes on passive income earned abroad. However, active business income can still qualify for deferral when properly structured. For example, a U.S. company manufacturing products in Singapore through a local subsidiary can reinvest profits locally without triggering immediate U.S. taxation. Popular jurisdictions for offshore corporations include Singapore, Ireland, and the United Arab Emirates, each offering distinct advantages. Singapore provides a stable banking system and extensive treaty network, while Ireland combines low corporate tax rates with European Union membership benefits. The UAE attracts wealth with zero corporate tax in many sectors and sophisticated financial infrastructure. Clients represents a critical aspect of offshore corporate planning. The Foreign Account Tax Compliance Act, FATCA, requires extensive reporting of foreign financial accounts and corporate interests. Failure to file required forms like the FBAR, Foreign Bank and Financial Accounts Report, can result in severe penalties. Working with qualified international tax counsel ensures proper reporting while maximizing available benefits. Modern offshore corporate structures often employ multiple entities in different jurisdictions to optimize tax efficiency. A holding company in one country might own operating subsidiaries in others, with careful attention paid to treaty benefits and local tax rules. This approach, known as treaty shopping, allows businesses to minimize withholding taxes on cross-international payments while maintaining full legal compliance. The most successful offshore strategies typically combine corporate structures with other tax planning tools. For instance, an offshore corporation might own foreign real estate, generating rental income that qualifies for preferential tax treatment. Or, a foreign corporation might serve as an investment vehicle for international securities, allowing profits to compound tax-deferred while maintaining asset protection benefits. Digital businesses present particularly attractive opportunities for offshore corporate planning. With careful structuring, online service providers can legitimately locate significant business operations in low-tax jurisdictions, taking advantage of the increasingly borderless nature of the digital economy. However, economic substance requirements mean real business activities must occur in the offshore jurisdiction. Beyond tax benefits, offshore corporations offer advantages in asset protection, privacy, and international business expansion. Many jurisdictions provide strong corporate veil protection, making it difficult for potential creditors to pierce the corporate structure and reach holders' personal assets. This protection, combined with tax benefits, explains why many wealthy people maintain portions of their business empires through offshore entities. The secret to successful offshore corporate planning lies not in any single strategy, but in creating integrated structures that align with legitimate business purposes while optimizing tax efficiency. When properly implemented with full compliance and substance, offshore corporations remain one of the most powerful tools in the wealthy's tax planning arsenal. Lesson 3. Tax-free municipal bonds. Municipal bonds represent one of the most straightforward and time-tested methods wealthy people use to generate tax-free income. These debt instruments, issued by state and local governments to fund public projects like schools, highways, and hospitals, offer investors a unique proposition: income that's completely exempt from federal taxes, and in many cases state and local taxes as well. The power of municipal bonds lies in their ability to generate what's known as triple tax-free income. For high-income investors in the top tax brackets, this tax advantage can result in municipal bonds yielding more after-tax income than corporate bonds with higher nominal yields. A municipal bond paying 4% tax-free could effectively yield the equivalent of a 6.7% taxable bond for someone in the 37% tax bracket. Smart investors leverage municipal bonds by creating strategic laddered portfolios that provide consistent tax-free income streams throughout retirement. By staggering maturities across different years, investors can maintain steady returns while minimizing interest rate risk. This approach also allows for reinvestment opportunities as bonds mature, enabling investors to take advantage of potentially higher yields in the future. The municipal bond market offers various instruments beyond traditional bonds. Zero-coupon municipal bonds, for instance, are purchased at deep discounts to their face value and don't pay periodic interest. Instead, they accumulate tax-free compound interest until maturity. This structure can be particularly valuable for investors planning for specific future expenses, such as college education costs or retirement income needs. However, municipal bonds require careful selection to maximize their tax benefits. The alternative minimum tax, IMT, can apply to certain types of municipal bonds, particularly those funding private activity projects. Sophisticated investors avoid these AMT regular bonds by focusing on general obligation bonds and essential service revenue bonds, which typically remain completely tax-free, regardless of the investor's tax situation. Geographic considerations play a crucial role in municipal bond investing. Residents who purchase bonds issued by their home state often enjoy complete exemption from state and local taxes, in addition to federal tax benefits. New York residents, for example, can achieve triple tax-free status by investing in New York municipal bonds, while California residents can do the same with California-issued bonds. The timing of municipal bond purchases can significantly impact their tax efficiency. Buying bonds at a discount to par value can create taxable capital gains when the bonds mature or are sold. Conversely, purchasing bonds at a premium can generate tax-advantaged amortization deductions. Understanding these nuances allows investors to structure their municipal bond portfolios for optimal tax efficiency. Professional wealth managers often complement municipal bond holdings with other tax-advantaged investments. By combining municipal bonds with strategies like qualified opportunity zones, real estate investments, and charitable trusts, investors can create comprehensive, tax-efficient portfolios that generate substantial tax-free income while maintaining diversification and managing risk. The municipal bond market's size and complexity create opportunities for sophisticated investors to find mispriced securities and capture additional yield without sacrificing tax benefits. Some investors work with specialized municipal bond managers who focus on identifying these opportunities while maintaining strict tax efficiency requirements. These managers often have access to new issue bonds and can negotiate better prices through their institutional relationships. Municipal bonds stand as a cornerstone of tax-efficient wealth building, offering predictable tax-free income streams while supporting essential public infrastructure. Their tax advantages become increasingly valuable as personal tax rates rise, making them an indispensable tool for wealthy investors seeking to protect their income from taxation while maintaining a conservative investment approach. Lesson 4. Charitable Trusts, Strategic Giving for Tax Efficiency. Charitable trusts represent one of the most sophisticated and effective ways wealthy people reduce their tax burden while supporting causes they care about. These powerful vehicles combine philanthropic goals with significant tax advantages, creating win-win scenarios for both donors and charitable organizations. At the heart of charitable trust planning lies the Charitable Remainder Trust, CRT, a structure that allows you to donate appreciated assets while retaining an income stream for yourself or other beneficiaries. When you transfer assets into a CRT, you receive an immediate tax deduction based on the present value of the future gift to charity. The trust then sells the appreciated assets without triggering capital gains taxes, as it's exempt from taxation. This creates a larger pool of capital to generate income, compared to if you had sold the assets yourself and paid taxes before reinvesting. The flexibility of CRTs becomes apparent in their various forms. A charitable remainder unit trust creates a fixed percentage of the trust's value, recalculated annually. This allows your income to grow if the trust's investments perform well. Alternatively, a charitable remainder annuity trust creates a fixed dollar amount, providing predictable income regardless of investment performance. Both structures offer ways to customize the planning to your specific needs and goals. Charitable lead trusts operate in reverse, providing income to charity for a term of years before returning assets to family members. This structure works particularly well in low-interest rate environments, as it can transfer significant wealth to the next generation at reduced gift tax costs while supporting charitable causes. The lead interest paid to charity generates current tax deductions, while the remainder interest passes to family with minimal gift tax impact. Donor-advised funds, DAFs, offer a simpler alternative to private foundations while providing many of the same benefits. Contributing appreciated assets to a DAF generates an immediate tax deduction while allowing you to recommend grants to charities over time. This separation of the timing of the tax deduction from the actual charitable gifts provides valuable tax planning flexibility. DAFs also eliminate the administrative burden and public disclosure requirements of private foundations. For substantial wealth, private foundations remain attractive despite their complexity. They offer maximum control over charitable giving and can employ family members with reasonable compensation. Private foundations can also own businesses and real estate, providing additional planning opportunities. The key lies in understanding the strict rules governing private foundations, including minimum distribution requirements and self-dealing prohibitions. The true power of charitable trusts emerges when combined with other tax planning strategies. For example, using a CRT to hold appreciated real estate before a sale can defer capital gains while generating income tax deductions. The trust's income stream can then fund life insurance held in an irrevocable trust, ultimately replacing the wealth for family members. This combination of techniques multiplies the tax benefits while accomplishing both charitable and family goals. And investing into technical requirements for charitable trusts proves essential for successful implementation. The trust language must meet IRS requirements, payout rates must fall within acceptable ranges, and investments must be managed appropriately. Working with experienced counsel and tax advisors ensures these requirements are met while maximizing the tax benefit. The investment strategy for the trust assets should align with both the income needs of the current beneficiaries and the ultimate charitable objectives. Lesson 5. Living through LLCs. The concept of living through LLCs represents one of the most powerful and frequently overlooked tax strategies employed by wealthy people. While most people view limited liability companies solely as business entities, savvy entrepreneurs and investors understand their potential as vehicles for transforming personal expenses into legitimate business deductions. At its core, this strategy involves structuring your life activities through properly formed and maintained LLCs. Consider your personal residence. Instead of owning it directly, you can create an LLC to hold the property, then lease it back to yourself or your operating business. This arrangement creates legitimate business expenses while maintaining control over the asset. The key lies in establishing fair market rent and maintaining proper documentation to support the business purpose of such arrangements. Family Limited Partnerships, FLPs, take this concept further by creating a framework for family wealth management while generating additional tax benefits. When properly structured, an FLP can hold various assets, from real estate to investment portfolios, while providing legitimate tax deductions for management fees, professional services, and operating expenses. The partnership structure also offers valuable opportunities for income splitting among family members, potentially reducing the overall family tax burden. One particularly effective application involves using LLCs for vehicle ownership and operation. Rather than purchasing a car personally, wealthy people often create an LLC that owns the vehicle and leases it for business purposes. This structure allows for the deduction of expenses such as maintenance, insurance, fuel, and depreciation, provided the vehicle serves a legitimate business purpose and proper records are maintained. The strategy extends to home offices, entertainment facilities, and recreational properties when these assets serve legitimate business purposes. For instance, a vacation home held in an LLC can become a corporate retreat center, transforming personal usage into deductible business expenses when properly documented and utilized. The key lies in maintaining a clear separation between business and personal use, with appropriate allocation of expenses based on actual usage patterns. Smart LLC structuring also creates opportunities for asset protection beyond tax benefits. By placing assets in separate LLCs, wealthy people create multiple layers of legal protection while maintaining operational efficiency through holding company structures. This approach not only optimizes tax treatment, but also shields assets from potential creditors and lawsuits. Technology and entertainment expenses often represent another significant opportunity for tax savings through LLC structures. When properly documented, items like computers, smartphones, streaming services, and internet connectivity can become legitimate business expenses rather than personal expenditures. The same applies to travel expenses. When trips combine business and pleasure, proper LLC structuring allows for the deduction of business portions of these expenses. However, aggressive implementation of these strategies can trigger IRS scrutiny. The key to success lies in maintaining proper corporate formalities, including separate bank accounts, thorough documentation of business purposes, and regular board meetings when appropriate. Payments between related entities must reflect fair market values, and personal use of business assets must be properly accounted for, as taxable fringe benefits when applicable. The real power of living through LLCs emerges when multiple strategies are combined thoughtfully. For example, an LLC structure might own a primary residence, lease it to an operating business, and simultaneously serve as a vehicle for legitimate home office deductions. The same entity could also own vehicles used for business purposes and manage investment activities, creating a comprehensive framework for tax-efficient living while maintaining legal compliance and asset protection. Lesson 6. Wealth Transfer via Gifting. Strategic gifting stands as one of the most powerful yet underutilized methods wealthy people employ to transfer assets while minimizing tax exposure. The IRS currently allows people to give up to $17,000, 0 cents per person, annually without triggering gift tax consequences. This amount, known as the annual gift tax exclusion, creates substantial opportunities for systematic wealth transfer when properly leveraged across multiple recipients and years. The true power of gifting emerges when combining annual exclusions with lifetime exemption planning. As of 2024, people can transfer up to $13,610,000 0 cents during their lifetime or at death without incurring federal estate or gift taxes. Married couples can effectively double this amount to $27,220,000 0 cents through proper planning and gift-splitting arrangements. This substantial allowance enables wealthy families to transfer significant assets to the next generation, while the parents maintain control over their core wealth. Education and medical expense payments offer another valuable gifting avenue that many affluent families overlook. The IRS permits unlimited direct payments to educational institutions and medical providers on behalf of any individual without counting against annual or lifetime gift tax exemptions. This provision allows grandparents to fund grandchildren's private school or college education while reducing their taxable estate and supporting their family's future generation. Dynasty trusts represent a sophisticated approach to multi-generational wealth transfer through gifting. These trusts, established in states with favorable trust laws, can theoretically exist forever, allowing assets to grow and benefit multiple generations without incurring additional transfer taxes. By funding a dynasty trust with assets likely to appreciate significantly, wealthy people can remove future growth from their taxable estate while providing for their descendants across multiple generations. Valuation discounts present another powerful gifting strategy, particularly for family business interests. When transferring minority stakes in closely held businesses or family-limited partnerships, donors can often apply legitimate discounts for lack of control and marketability. These discounts, which can range from 20% to 40% or more, effectively allow the transfer of more economic value within annual and lifetime exemption limits than would otherwise be possible. Timing considerations play a crucial role in maximizing gifting strategies. Making gifts early in the calendar year allows any subsequent appreciation to occur outside the donor's estate. Additionally, gifting assets during market downturns can transfer more potential future value while using less of the donor's exemption amount. Strategic timing also involves considering the recipient's life circumstances, such as upcoming marriages, business ventures, or other significant life events that might affect the optimal timing of gifts. The coordination of various gifting techniques often yields the most substantial tax benefits. For example, combining annual exclusion gifts with education funding and strategic business interest transfers can create a comprehensive wealth transfer plan that maximizes tax efficiency while achieving family objectives. This coordinated approach requires careful documentation and potentially the involvement of qualified advisors to ensure compliance with complex gift tax rules and regulations. Looking forward, gifting strategies become even more critical as tax laws evolve and wealth transfer opportunities shift. The current lifetime exemption amounts are scheduled to sunset in 2026, potentially reducing by roughly half unless Congress takes action. This pending change creates urgency for wealthy people to implement comprehensive gifting strategies while more favorable limits remain in place. Understanding and acting on these opportunities represents a fundamental aspect of preserving family wealth across generations. Lesson 7. 1031 Property Exchanges, the Ultimate Tax Deferral Strategy. The 1031 exchange stands as one of the most powerful wealth-building tools in real estate investment, allowing investors to defer capital gains taxes indefinitely while growing their property portfolios. This strategy, named after Section 1031 of the Internal Revenue Code, enables property owners to sell investment properties and reinvest the proceeds into like-kind properties without triggering immediate tax consequences. The magic of a 1031 exchange lies in its ability to preserve investment capital that would otherwise be lost to taxation. When an investor sells a property for $1 million, 0 cents that was purchased for $400,000, 0 cents, they would typically owe capital gains tax on the $600,000, 0 cents profit. However, by utilizing a 1031 exchange, they can reinvest the entire $1 million 0 cents into a new property, maintaining their full investment power and potentially generating even greater returns. Understanding the strict timeline requirements is crucial for successful execution. Investors must identify potential replacement properties within 45 days of selling their relinquished property and complete the purchase within 180 days. This timeline creates a sense of urgency, but skilled investors use this pressure to their advantage, often having replacement properties lined up before initiating the exchange. The concept of like-kind property is broader than many realize. An investor can exchange a small apartment building for raw land, a strip mall for a warehouse, or even multiple properties for a single larger property. This flexibility allows investors to shift their real estate strategy as market conditions change, moving from high management existence properties to more passive investments or from saturated markets to emerging opportunities. Delaware statutory trusts have emerged as a valuable tool within the 1031 exchange framework. These instruments allow investors to own fractional interests in institutional-grade properties they couldn't afford independently. A property owner selling a $2 million zero-cents apartment building could invest in portions of multiple high-end commercial properties managed by professional teams, effectively upgrading their portfolio quality while maintaining tax deferral benefits. The construction of a 1031 exchange requires careful attention to detail. All funds must be handled by a qualified intermediary, never touching the investor's hands, and the replacement property must be of equal or greater value to achieve full tax deferral. Debt replacement rules also apply, requiring investors to maintain similar levels of leverage to avoid partial taxation. Advanced investors often create chains of 1031 exchanges throughout their careers, continually rolling profits into progressively larger or more profitable properties. This strategy, combined with a step-up in basis at death, can allow real estate investors to build substantial wealth while legally avoiding capital gains taxes throughout their lifetime. Their heirs then receive the properties at a stepped-up basis, effectively eliminating the deferred tax liability. Reverse exchanges present another sophisticated application of Section 1031. In competitive markets where replacement properties must be secured quickly, investors can acquire their new property before selling their existing one. While more complex and typically more expensive to execute, reverse exchanges provide valuable flexibility in timing and solemnity situations. The true power of 1031 exchanges becomes apparent when combined with other tax strategies. Investors can use cost segregation on their replacement properties to accelerate depreciation, employ Delaware statutory trusts for estate planning purposes, or structure exchanges through LLC entities for additional asset protection. This layering of tax benefits creates a comprehensive wealth preservation strategy that sophisticated investors use to build generational wealth through real estate. Lesson 8. Business Write-Offs. The art of business write-offs represents one of the most powerful yet frequently misunderstood tax reduction strategies available to wealthy people. While the average employee can only deduct a limited set of expenses, business owners can transform many aspects of their lives into legitimate tax deductions through proper structuring and documentation. At its core, the principle behind business write-offs is simple. Any ordinary and necessary expense incurred in the pursuit of profit can potentially be deducted from taxable income. The key lies in understanding how to properly categorize and document these expenses while staying within IRS guidelines. Successful entrepreneurs often structure their lives to maximize the overlap between personal activities and business. Travel provides an excellent example of this strategy in action. While purely personal vacation expenses are not deductible, combining business meetings or research with travel can transform much of the cost into legitimate write-offs. Private jet travel, luxury hotels, and fine dining can become partially deductible when properly tied to business purposes. The key is maintaining thorough documentation of the business purpose and keeping personal and business time clearly separated. Vehicle expenses represent another major opportunity for tax savings. By properly documenting business use of vehicles, entrepreneurs can deduct not only direct operating costs, but also depreciation on luxury vehicles. Many wealthy people maintain detailed mileage logs to support significant vehicle deductions while still enjoying personal use of high-end automobiles. Home offices have evolved into a particularly valuable write-off in the modern business environment. When properly established, a home office can convert a portion of mortgage interest, property taxes, utilities, repairs, and even cleaning services into business deductions. The space must be regularly and exclusively used for business, but this requirement can often be met while maintaining an aesthetically pleasing living environment. Entertainment and meals continue to offer write-off potential, though recent tax law changes have modified the rules. While pure entertainment expenses are no longer deductible, business meals remain 50% deductible in most cases. Savvy business owners carefully structure their social activities to qualify as business meals through proper documentation of business discussions and participants. Technology and equipment purchases provide significant write-off opportunities through Section 179 expensing and bonus depreciation. Rather than gradually depreciating these assets, business owners can often deduct the full cost in the year of purchase. This applies not only to computers and office equipment, but potentially to vehicles over 6,000 pounds, and even aircraft used partially for business. Health insurance and medical expenses become much more deductible when properly structured through a business. Self-entitled people can deduct health insurance premiums for themselves and their families. Some businesses establish medical expense reimbursement plans that allow for tax-free payment of medical expenses not covered by insurance. Education and professional development expenses are fully deductible when related to maintaining or improving business skills. This can include executive coaching, industry conferences, specialized training, and even certain degree programs. Wealthy people often structure their pursuit of knowledge to qualify as business education. The most sophisticated tax minimization strategies combine multiple categories of write-offs into comprehensive business structures. A real estate professional might combine vehicle expenses, home office deductions, travel costs, and professional development into a single business entity that supports their investment activities while generating significant tax savings. Lesson 9. Foreign Income Exclusions. The Foreign Earned Income Exclusion, FEID, represents one of the most powerful yet underutilized tax benefits available to Americans working internationally. In 2023, qualifying people can exclude up to $120,000, 0 cents of foreign earned income from U.S. taxation, creating a significant opportunity for those willing to embrace a global lifestyle. The key to unlocking this tax advantage lies in meeting either the physical presence test or the bona fide residence test. Under the physical presence test, people must spend at least 330 full days outside the United States during any consecutive 12-month period. This requirement demands careful tracking of travel days, as even brief visits to the U.S. can impact eligibility. The bona fide residence test offers more flexibility, but requires establishing genuine residency in a foreign country for an uninterrupted period spanning an entire tax year. Sophisticated tax planners often combine the FEIE with the foreign housing exclusion, which allows additional deductions for housing expenses above a base amount. This combination can result in substantial tax savings, particularly in high-cost cities like Hong Kong, Singapore, or London. The housing exclusion covers expenses such as rent, utilities, property insurance, and even parking fees, though food and domestic help are notably excluded. Total nomads and remote workers have increasingly discovered ways to leverage these exclusions while maintaining U.S.-based businesses or consulting practices. By carefully structuring their work arrangements and choosing tax-friendly jurisdictions, they can maximize their excluded income while building location-independent businesses. Some entrepreneurs establish foreign corporations in jurisdictions with favorable tax treaties, creating additional layers of tax efficiency. The strategic use of timing can dramatically impact the benefits received. For example, arriving in a foreign country mid-year might suggest waiting until the following year to claim the exclusion, allowing for optimal use of the full amount. Similarly, planning departures around tax year boundaries can help maximize excluded income across multiple years. High-income earners often combine the FEE with other international tax strategies, such as the Foreign Tax Credit, FTC. While you cannot claim both the FEE and FTC on the same income, careful planning can allow you to use the FEE for earned income while applying the FTC to investment income or earnings above the exclusion threshold. This layered approach creates a comprehensive international tax strategy that minimizes overall tax liability. Self-employed people face additional considerations when working abroad. While the FEIE applies to income tax, it does not exempt self-employment tax. However, totalization agreements between the U.S. and various countries can provide relief from double Social Security taxation. Understanding these agreements and structuring work arrangements accordingly can lead to significant savings. The IRS scrutinizes foreign income claims closely, making proper documentation essential. Maintaining detailed records of physical presence, establishing tax home requirements, and documenting the nature of foreign earned income can prevent costly disputes. Professional assistance from tax advisors familiar with international tax law often proves invaluable in navigating these complex requirements. The revocation of FEIE election requires IRS approval and triggers a 5-year waiting period before it can be claimed again. This restriction underscores the importance of careful planning before implementing an international tax strategy. The decision to utilize the FEIE should align with long-term career and lifestyle goals rather than short-term tax advantages. Lesson 10. Capital gains advantages. The wealthy have long understood that not all income is taxed equally, and capital gains represent one of the most powerful tools for building wealth while minimizing tax obligations. At its core, the preferential treatment of capital gains stems from the government's desire to encourage long-term investment and economic growth. This creates numerous opportunities for sophisticated investors to structure their income in ways that maximize tax efficiency. Long-term capital gains rates currently max out at 20% for the highest earners, compared to ordinary income tax rates that can exceed 37%. This 17% difference represents a massive opportunity for wealth preservation, particularly when combined with strategic timing of realizing gains and losses. The wealthy often hold appreciated assets indefinitely, allowing their value to compound tax-free until they need to access the capital or can offset the gains with strategic losses. Sophisticated investors frequently employ tax loss harvesting throughout the year, strategically selling investments at a loss to offset capital gains in other parts of their portfolio. This technique, when properly executed, can effectively reduce or eliminate tax liability on investment gains while maintaining similar market exposure through careful navigation of wash-sale rules. The key is maintaining detailed records and understanding the distinction between short-term and long-term holdings. Basis stepped up at death represents another powerful capital gains advantage that the wealthy leverage in their estate planning. By holding appreciated assets until death, the cost basis is stepped up to the fair market value at the time of death, effectively eliminating any capital gains tax liability that would have been due on the appreciation during the original owner's lifetime. This creates a powerful incentive to hold appreciated assets rather than sell them, particularly for older investors. The Qualified Small Business Stock, QSBS, exclusion offers another significant capital gains advantage, allowing investors to exclude up to 100% of their gains on eligible startup investments held for more than 5 years. This provision has become increasingly popular among wealthy investors and entrepreneurs who structure their business investments to qualify for this substantial tax benefit. The potential tax savings can reach millions of dollars per investment, making it a crucial consideration in startup investment strategies. Opportunity zones present a relatively new capital gains advantage that wealthy investors are increasingly utilizing. By reinvesting capital gains into qualified opportunity zone funds, investors can defer tax on the original gain and potentially eliminate tax on subsequent appreciation if the investment is held for 10 years. This program has created a new avenue for tax-efficient real estate and business investment in designated low-income communities. Careful structuring of investment vehicles can further enhance capital gains advantages. For example, using specific share identification when selling securities allows investors to select the highest cost basis shares for sale, minimizing taxable gains. Similarly, exchange-traded funds, ETFs, often offer more tax-efficient exposure to various asset classes compared to mutual funds due to their unique creation/redemption mechanism. The wealthy also leverage various financial instruments to defer or transform ordinary income into capital gains. Carried interest provisions, although controversial, allow private equity and hedge fund managers to treat much of their compensation as capital gains rather than ordinary income. Similarly, certain derivative strategies can be employed to convert dividend income into capital gains, or defer recognition of gains to more tax-advantaged events. Finding and implementing these capital gains advantages requires careful planning and often the assistance of skilled tax and legal professionals. The complexity of these strategies creates a natural barrier that tends to benefit those with the resources to properly execute them. However, even investors with more modest means can benefit from understanding and implementing these principles at an appropriate scale for their situation. Lesson 11. Deferred compensation. The wealthy have long understood that timing is everything when it comes to taxation, and nowhere is this more evident than in the strategic use of deferred compensation. This sophisticated approach to wealth preservation allows high-income earners to postpone receiving earned income until a more tax-advantaged time, often years or even decades into the future. Deferred compensation comes in two primary flavors: qualified plans like 401(k)s and pension plans, and non-qualified deferred compensation (NQDC) plans. While qualified plans are subject to strict contribution limits and non-discrimination rules, NQDC plans offer virtually unlimited deferral potential for executives and key employees. These arrangements allow participants to defer substantial portions of their salary, bonuses, and other compensation, effectively creating their own personalized tax timing strategy. The power of NQDC plans lies in their flexibility. Executives can elect to defer compensation before it's earned and specify exactly when they want to receive it in the future. This might mean deferring income during peak earning years, when they're in the highest tax brackets, and taking distributions later in retirement when their tax rate is lower. Some executives even structure their deferrals to coincide with planned relocations to lower tax states, maximizing the geographic tax arbitrage opportunity. However, deferred compensation isn't without risks. Unlike qualified plans, NQDC arrangements are essentially unsecured promises to pay from the employer. This means the deferred compensation remains subject to the company's creditors if the business faces financial difficulties. Sophisticated executives mitigate this risk by carefully evaluating their employer's financial stability and often negotiating for rabid trusts or other protective mechanisms to secure their deferred compensation. The tax benefits of deferred compensation extend beyond simple rate arbitrage. When properly structured, these arrangements can also help avoid state income taxes entirely. For example, an executive working in a high-tax state like California might defer compensation while working there, then take distributions after establishing residency in a no-income tax state like Florida or Texas. This strategy alone can save hundreds of thousands or even millions in state taxes. Another powerful aspect of deferred compensation is its ability to complement other tax-advantage strategies. Many executives combine NQDC plans with life insurance arrangements, charitable planning, and estate tax strategies to create comprehensive wealth preservation structures. For instance, deferred compensation can be used to fund premium payments on life insurance policies held in irrevocable trusts, effectively leveraging pre-tax dollars for estate planning purposes. The timing of elections in deferred compensation planning is crucial. The IRS has established strict rules under Section 409A regarding when and how deferral elections must be made. These elections generally must occur before the year in which the compensation is earned, and once made, they are largely irrevocable. This requirement forces executives to think strategically about their long-term financial planning and tax situation. Smart executives also use deferred compensation as a powerful tool for investment growth. Since the deferred amounts can often be invested in a variety of options selected by the employer, executives can potentially earn returns on money that would otherwise have gone to taxes. This tax-deferred compounding can significantly accelerate wealth accumulation, especially over longer deferral periods. For business owners and entrepreneurs, customized deferred compensation arrangements can be even more flexible. They can design plans that align with their business goals while optimizing their personal tax situations. This might include performance-based triggers, company sale provisions, or other specialized features that standard qualified plans don't offer. Lesson 12. Life insurance as a wealth shelter. Life insurance represents one of the most powerful and least understood tax shelters available to high net worth people. While most people view life insurance primarily as a death benefit tool, sophisticated investors and their advisors recognize it as a versatile vehicle for tax-advantaged wealth accumulation and transfer. The fundamental tax advantage of life insurance lies in its unique treatment under the Internal Revenue Code. Death benefits pass to beneficiaries completely free of income tax, regardless of the amount. This creates an immediate opportunity for wealthy people to transfer substantial sums to the next generation without triggering estate or income taxes, provided the policy ownership is properly structured. Private placement life insurance, PPLI, takes these benefits to another level by allowing high net worth investors to wrap tax-inefficient investments inside an insurance wrapper. Hedge funds, actively traded securities, and high-yield investments that would typically generate significant annual tax liability can grow tax-free within a PPLI structure. This strategy proves particularly valuable for investors in high-tax states or those dealing with investments that produce substantial ordinary income. The cash value component of permanent life insurance offers another layer of tax advantages. When structured properly, policy owners can access their cash value through loans rather than withdrawals, effectively creating tax-free income streams during their lifetime. This strategy works particularly well with indexed universal life policies, which can provide market-linked returns without direct market exposure. Corporate-owned life insurance, Colline, presents additional planning opportunities for business owners. Companies can purchase life insurance on key executives, deduct premium payments in certain circumstances, and receive tax-free death benefits. These policies can fund deferred compensation arrangements, provide corporate liquidity, and facilitate business succession planning while creating favorable tax outcomes for all parties involved. Life insurance also plays a crucial role in advanced estate planning techniques. By establishing an irrevocable life insurance trust, ILIT, wealthy people can remove life insurance proceeds from their taxable estate while maintaining indirect control over how the proceeds are distributed and used. The trust can be designed to provide liquidity for estate taxes, equalize inheritances among children, or create lasting multi-generational wealth transfer solutions. Premium financing arrangements allow investors to leverage their wealth by borrowing funds to pay large insurance premiums. This strategy can be particularly effective when interest rates are low and the expected returns inside the policy exceed borrowing costs. The arbitrage opportunity, combined with the tax-free treatment of policy growth and death benefits, can create substantial wealth accumulation opportunities. The most sophisticated planning combines multiple insurance-based strategies with other tax minimization techniques. For example, a business owner might use a combination of COLI, premium financing, and an ITLIT to create tax-efficient retirement income, protect business assets, and transfer wealth to future generations. The synergistic effects of these combined strategies often exceed the benefits of implementing them individually. National life insurance products offer additional planning opportunities for globally minded investors. Offshore policies can provide asset protection benefits, privacy advantages, and access to investment options not readily available in domestic policies. However, these arrangements require careful attention to reporting requirements and compliance with U.S. tax laws to avoid costly penalties. Understanding the technical aspects of life insurance taxation opens doors to creative planning opportunities. The ability to customize policy design, investment options, and ownership structures allows wealthy people to achieve multiple financial objectives while minimizing their tax burden. As tax rates potentially increase and other planning techniques face greater scrutiny, life insurance remains a resilient and adaptive tool for protecting and growing wealth across generations.